morning, everybody, and welcome. We have a fantastic panel, but only for a very short time. So I'm going to leap straight into it. Thank you so much, Naomi, for introducing us all. We're talking about mobilizing capital to emerging markets and developing economies. We often say from global north to global south. We're going to touch on the new collective quantified goal. We're going to hopefully discuss innovative models and not only focus on some of the very real barriers that exist to mobilizing capital. I'm going to start with you, Derek, if I may. Would you like, we're going to talk a fair bit about the new collective quantified goal, and before we get into that, I just wanted maybe you to explain to the audience what exactly that is in case we're not all familiar.
First of all, thanks a lot for welcoming us. It's a pleasure being here. In 2009, a set of developed economies decided to set a target of 100 billion a year towards emerging economies to be reached by 2020. It has been quite a cumbersome path to get there, but it seems to me that finally we got there. In 2015, there was a reflection about a new generation of goals that needs to be structured and developed, having in mind that the minimum buffer, if you wish, or starting point should be at least 100 billion, but for sure should be a lot more than that. And these new goals are going to be theoretically announced in Azerbaijan at COP29 later during the year. Really briefly, from our perspective, if you look at the principles that it should follow, transparency, predictability, progressivity, consistency, in terms of the sources as well, it's going to be a mix of public, private finance, as well as other type of innovative solution that needs to be considered. In terms of the distribution, it needs to tackle adaptation, mitigation, and obviously the loss and found damage. And then finally, in terms of the location, you have to look at it from a regional perspective, sectorial perspective, as well as a national, local, community perspective. What's going to be extremely important is that it connects really directly with the needs of the emerging economies, which has not always been the case in the past. That there's traceability, reporting standards that are being established.
Fantastic, thank you. And then over to you, Mike, to maybe build on some of those comments.
Thanks, Rhian-Mari. Yeah, just to build on that great description of the goal, I think, so there are actually important talks in Bonn next week that I would recommend people keep an eye on to understand the direction of travel for these discussions. So without preempting those, I think the positive elements that are emerging versus the previous target that was very fixed, didn't really have a lot of relationship to the needs of countries, is firstly a big effort to really link this goal to costed NDCs at the sovereign level and to corporate transition plans, as Dr. Moderator was talking about, which is where a lot of the financing needs to go. So that, I think, is a big positive that's emerging in these discussions. The second is to think about public finance at the center of a sort of layered system that we're all very familiar with public capital, with MDB and other kinds of concessional capital, and then with private capital. And hopefully the direction of travel here is to think much more about the outputs from that system, the total amounts of finance that are being leveraged, rather than fixating on a single number for that public finance. And I say the last thing that I think is important for people to have in mind, though, is that when you look at the needs and you look at that system, it is going to become increasingly clear that we do need to grow the amount of fiscal space for that public finance. And if you then look at some of the discussions going on in the G20 around different kinds of novel taxation or things like shipping tax, that is going to have to be linked in to create the public finance that is then needed for the whole system.
Thank you for that. There was a report out yesterday, I think, by a charity called Debt Justice, which it said that debt payments by the 50 countries most vulnerable to the climate crisis had doubled since the start of the coronavirus pandemic, and it now stands at the highest level in more than 3 decades. So I think as we're on this topic of how we're mobilizing capital, the form of capital is incredibly important. Mike, back to you on that before I ask some of the other panelists, because I know you've been doing a fair bit of work on this, and I guess that's the point that you're talking about, is how do we use public finance to catalyze other types of finance? But again, we need to be forensic about the types of finance that we use. Yeah?
No, absolutely. So, I mean, we support a number of developing countries and groups like the V20, looking at how to make that capital better in quality, the affordability, the appropriate kinds of capital. I think again, Dr. Maurer talked about reducing risk premia, particularly perceived risk premia, and Rowan talked on the panel earlier about insurance. There are other things, FX hedging, that the MDB system and others are now innovating around. Innovative instruments. Again, London has been, I think, a real center for thinking about things like sustainability-linked bonds, different kinds of carbon financing instruments. But I think, again, coming back to linking these discussions on private capital with the discussions that are happening around public policy. So looking at ways to support developing countries, some people may have picked up on these discussions around country platforms, building on things like the JETP facilities in South Africa and elsewhere that you've been working with Rhian-Mari to really build capacity of government in emerging markets to absorb capital more efficiently, manage sort of macro fiscal. So again, I think we're going to need all of those pieces if we're actually going to get the quantum and the quality of capital to flow.
Brilliant. It's not just radical collaboration, it's looking at that whole value chain.
That's right.
Marissa, you've been nodding vigorously through some of those points.
Music to my ears, yes. Yes, so we're deep in the middle of a lot of this work. I am the CSO of Standard Chartered, and we're in 52 footprint markets. Most of them are developing economies. And maybe we can just touch on the JETPs for a moment in terms of the vision, and I'm not sure, maybe to level set for the audience what that actually is. So the vision behind the JETPs was to take two Western host governments as leaders, committing development capital or concessionary capital in match funding alongside private capital in a handful of developing market economies whose sole dependency is coal for their energy source. So it's a systemic look at trying to decarbonize some of these developing economies. Now, for those of you who've been following this, this is hard graft. This is needing policy changes, as you so rightly point out. It's capacity building to absorb. How do you produce all of these projects? Because if you're looking at country level, for instance, one of the ones that we're working on right now, which has, in theory, a 20 billion of capital allocated, so 10 from the MDB world and 10 from private capital circled to try to create all these projects in the country of Indonesia. Very complicated topography. There is no one size fits all. Some islands are better for solar, some wind, some hydro. So you have multiple projects, but the idea was this umbrella concept of a pool of capital that could then be allocated to kickstart these projects. When we got into the thick of it, though, and this is where rubber meets the road, is rolling up your sleeves and understanding what the issues are, the very first thing that we came onto was that in these economies, and in this economy in particular, the coal plants are very young. We call them teenagers relative to the West. So in order to shut them down early, somebody needs to be paid out for that. And it's very untenable for a private sector actor to say, I'm going to pay somebody to shut down coal when most of us in the banking community have coal restrictions. On the other hand, it's very untenable for the MDB world in many economies that might be having to tweak turning on coal in their country to go say, I'm going to shut it down somewhere else. So these are the realities of getting into some of this work. But with a common mission, we keep plugging away at things. So we're in the middle of one of the first public and private blended finance facility, which will be raised to actually shut down a coal plant early. And then in the farther innovative end of the spectrum, we're actually exploring the idea of creating a very unique type of carbon credit, because once you shut down a plant, you can calculate what those emissions reductions are, generate a carbon credit, and the buyer of that credit then helps pay to shut down early. And we already have one progressive country who's raised their hand to buy those credits. So this is the type of innovative finance that is really pushing this agenda of, and this is real scale capital, right? This is systemic change that's very exciting. And then one quick one, if I may, which I'm very delighted that you also talked about adaptation. Another area that we are very focused on, we've been 80+ % of climate finance to date has been in the area of mitigation or going to reduce carbon emissions. Critically necessary, of course. But the reality is, as we start to see all this extreme weather activity happen, what we also realize is no matter what we do, this is a reality. This is here to stay, and it's deeply affecting the developing markets. And historically, the idea that money would flow to adaptation or resilience was very much, at least in the private sector, the belief is that's government's job. And yet this government capacity problem is real. Most of the governments who are affected don't have extra wherewithal to go invest in resilient business models. So we need to engage the private sector. So we're hard at work in creating a guideline in collaboration with many, many others. We've just produced, and very delighted to share, it's called the Guide to Adaptation and Resilience. This very much designed to define what we mean by adaptation, present a commercial opportunity for private sector actors, and then show 100 ideas of areas where folks can get involved in different segments of adaptation finance, because we're going to need some 300, 400 billion per year in order for us to address this very, very serious topic. And this really affects people in these economies.
Well, many congratulations on your recent report. I think it really is a bit of a myth buster in that I think for a long time we've looked at adaptation as a topic that doesn't lend itself to traditional revenue payback models, and therefore it isn't one that the private sector could get involved in. And I think it's a fantastic piece of work. So thank you, Marissa, and thank you, Derek, for raising it. Jamie, I haven't heard from you, and obviously you're doing a huge amount through the IFC in all these countries that we're discussing. And the point about horses for courses, going back to that point about how do we make sure the right types of funding is making its way to the right types of projects?
Thanks, Rhian-Mari. It's a pleasure to be here. So for those who don't know the IFC, we're the private sector arm of the World Bank. So we have the same ambition, which is poverty alleviation, but we do it through the private sector. So we are very specifically that catalytic capital. We are trying to do the first of a kind and work with colleagues from the private sector, with Marissa and others, crowd in private capital, and then if we can spark a market, catalyze it, then we step out of the way and let it flow. And if we get it right, we're using our money really carefully in that way and leading the way. And you're absolutely right that there are tensions in these conversations around climate finance, right? And you get anyone who's run a business knows that if you set KPIs are great because you get what you manage, but equally they're dangerous because if you don't get the right KPI, you'll get the wrong thing. So the KPI of climate finance at one point is justice. There's a justice element of that, which is the North giving the South some fair dues for a problem they didn't cause and are going to face the problems of. But there's also impact, which is that there's never going to be enough. So we've got to use the money very carefully to catalyze and achieve it, achieve as much as is possible to unlock the private sector. And of the 10 trillion a year of climate finance that's needed, there's a broad acceptance that 80% of that's got to come from the private sector. So how do you use that money as carefully as possible? Same tension in adaptation, right? So increasingly there's acceptance that the climate change is coming and we need resilience spend. Equally, we don't want to spend money for the sake of it. We want the outcome, which is resilience. And if we can do that through behavioral change or efficiently, we should absolutely do that. So I'll exemplify that in terms of some of the work we do. In the green building space, we have worked to unlock the markets for green buildings in emerging markets. And there wasn't a lead standard in all the countries, so we created, actually with Swiss, and you're in from there, and UK money, we created a free good, which is called EDGE, and it's a free tool and certification tool. We back that up with some capacity building for regulators and for the market, but then we put our own capital into it. We've lent 7 billion of our own money into property developers, through banks for green mortgages across the developing world. And in the language of COPs and negotiations, we have mobilized another 7 billion of private capital into those transactions. More exciting for us is that we now know that EDGE certified buildings count for $80 billion worth of investment in green buildings across the emerging markets. So that doesn't get counted on our dime, but is that catalytic bigger impact that we're trying to have. And now on the resilience side, we're super excited. We've got an equivalent tool, the Building Resilience Index, where we're hoping to work with the insurance industry and banks to try and drive a similar kind of change. So it's that catalytic capital, how much can we draw in other money and then actually unlock markets to have long-term change.
That's absolutely great to hear those examples. Jamie, I'm challenging you to leverage your capital even further than your one-to-one, but I know you're working on it. So
well, so on that one, it's interesting. So the one-to-one, 7 to 7, that's the one-to-one. But we were having the conversation actually with the UK government of we've used 100 million of donor money, which is probably at the purest sense what's being negotiated at COP as in terms of the NCQG, how much is going from north to south. 100 million of donor money has turned into $80 billion of investment in green buildings. So that's an 800x, right?
Okay.
Can I just give you an interesting example that I was told the other day, which I hadn't appreciated until I found out about this. We all probably remember the floods in Pakistan that wiped out buildings far and wide. There were only 2 buildings that stood during that catalytic event, that catastrophic event, and they were schools, which isn't necessarily obvious. Why did they stand when all others fell? They were because they were UN-funded schools that were built to a very specific type of code that is much stronger and could withstand all of this. This is sort of what we mean by this adaptation finance concept. So if we start building and get governments to write this into their building requirements, if we have organizations like yours creating that common standard for the developing markets about what a green and strong and a resilient and adaptive building looks like, surely those are going to be the goods and services that people are going to want to buy because they will stand. The insurance community should want to finance those from an insurance provider perspective. We'd love to lend into it. So then that system starts to work and we're getting that leveraging effect and we're driving capital as a true commercial proposition into resilience and adaptation.
That's brilliant. We don't want to talk entirely about buildings because there's so many other sectors, but I think the examples that you've cited do highlight or suggest a challenge as well, which is it can be more expensive to build buildings to these types of specs. And that again goes to this point of when you've got that premium, isn't that the role where public finance can be used most catalytically in order to make that something that the developers can invest in and meet their risk-adjusted returns?
Maybe you're the first few that, but ultimately what you wanted is the market to work to be sustainable. So
Build the
ultimately,
supply chain.
as Marissa says, if we can persuade insurers to give us discount on insurance for that, then it will be self-fulfilling. And so that initial bit of public nudge gets you off and running.
All about pump priming and actually making sure you bring in the market. Absolutely, we're all in agreement. Derek, on this point about making sure that it's the right capital going to the right projects and that concessionary capital is being used catalytically, any thoughts from you?
I mean, the role that the World Economic Forum is attempting to play on that very topic, we're not the place for commitments. You have UNEP, you have GFANS and other organizations. I think the role that we can play is rather from going to commitment to action and trying to support to a certain extent our partners on the financial side to act. And for that, we have built is multiple type of collaborations on the heavy industries, on sustainable agriculture, where we try to reflect on financial mechanism, breakthrough financing model, required collaboration for the future, change of business model. Then another category of activities that we do run is policy dialogue, the importance of reflecting on the structure of the incentive, the mandates, how reachable they are, the unintended consequences of some of them across regions as well. And then lastly, and we have spent a lot of our time on that, is building up demand signaling. And there we have supported the so-called First Mover Coalition for Heavy Industries. We have launched in January the First Mover Coalition for Food. And we are trying to create that type of confidence and trust that financiers could have, acknowledging the fact that there will be a party on the other side digesting the premium which are generating by this early stage technology that needs to be pushed forward.
Fantastic, thank you for that. This is where I encourage everyone in the audience to use the Slido and opportunity to ask questions of the audience here. I've had one that's come in and I will come back to that in a second, but the panel are more than happy to take questions if you'd like to submit a few of them. I want to go to this point of perceived risk in emerging markets and developing economies, and the fact that very few of them have an investment grade rating. So there is often this, this reticence to take project risk on top of country risk. So I'm going to come to you, Marissa, to talk about that. And just what are we seeing in terms of innovative solutions to get around some of those challenges?
Sure, so you're absolutely right. We are a large project finance banks and we operate in these countries. And for us, the challenge we have in a non-investment grade country is that sovereign ceiling provides the cap on the project itself most often. And there is currency risk and political risk and all the typical risks that you have. And then often you're having business model risk in terms of who's buying the offtake on these big projects. So how do you de-risk it in the first instance? It's a little bit your demand signal concept, right? If you have a purchase agreement on the other side and you're confident of who the buyer is and that buyer has a higher credit rating, that by definition helps you blend upwards in terms of the cap. One of the areas, though, that we are working on is how do you address this non-investment grade arena, because we're subject as a regulated entity to hold capital aside, and the more capital we have to hold, it's disproportionately non-linear, meaning the lower down you are on the investment grade curve or non-investment grade curve, the more capital we have to hold aside for every loan that we make, to the point where if you're a single B credit country or project, it's 5 times the notional. So if I want to lend $100, I have to hold $500 aside for that project, which then starts to make the economics very challenging. So how do we address that? One of the ways is in the catalytic arena. There's a project that's happening now with the World Bank, the Private Sector Investment Lab, where they've asked the private sector to co-collaborate on what are those areas where, if we thought differently, because today the World Bank has some caps on their own lending into non-investment grade countries. But what if we could change that? What if the mandate of perhaps these development finance entities is, since you have operate in those areas, it's okay to lend into them. That's part of your charter. The minute that happens, they could provide a layer or some other kind of credit support that would then create that new credit rating, if you will, for the project or opportunity. All of a sudden then, that cheaper capital from my side can flow and we're off to the races. I mean, that's just one of many things that we're looking at in collaboration with real practical examples. Here's the hurdle, what can we do about it? Here's the next one, what can we do about it? It's sort of chipping away systematically at some of the things that have prohibited these projects to flow at scale.
The point that you were making earlier, this is really hard graft.
It's hard graft, it is, it
And
is.
so
Otherwise we would have done it already.
Exactly. Jamie, further comments from you on
Yeah,
that
great.
point?
I'd pick up on that. So 4 things, right? And the risk of some repetition. One is fundamental de-risking at the asset level, right? So risk is a perception. If you can actually, risk is about confidence. And we've seen it in many developed countries that have run good renewable energy procurement programs. Brazil did it, South Africa did it, India did it. IFC created a tender in a box, scaling solar, that we've helped multiple small countries roll out. If countries consistently procure renewable energy projects from the private sector and pay on time for those projects, and they do it through multiple years and generations, then there's confidence is built and the underlying cost of capital comes down and the tariffs come down. So there's a lot of work to help the fundamentals of the risk. Second, as Marissa said, is there's opportunity to blend public capital and private capital. And IFC's mandate is to crowd in private capital and prove returns. So our money is priced at market returns, but we do act as we manage on behalf of donors, different UK government, others, to carefully blend public money as a first loss or some kind of tranche to do just enough to entice private capital into a transaction and hopefully prove that the second time round that's not necessary. The third is holding hands, right? So IFC is operating across 150 different markets. We have 75 years of investment experience, and so we act as an asset manager. And for institutionals who aren't comfortable in those zip codes to basically enjoy access to our pipeline in a diversified way, get to know the ropes and learn. There's a learning piece of it, because not everyone's busy in our markets like Marissa. And then the third is data. So, we have recently just issued data on our historic investments under it's called GEMS database, Global Emerging Market something. You can look it up, GEMS, and it's aggregated data from the MDBs of our experience on lost rates, collection rates, et cetera, to try and make sure that the perceived risk in bank models isn't overpricing, and sometimes it's the same model, right? Because they allow you to use them. So there's a circularity there that both the banks and their regulators to just make sure that we're not all shooting ourselves in the foot with unnecessary fear.
That's fantastic news on the GEMS. I think, Mike, you've been calling for a long time about the ability for the multilateral development banks and the development finance institutions to publish some of their historic default rates, which really do, again, it's busting the narrative around how we view perceived risk. And as you say, 75 years of investment experience and pioneering the way in investing in this type of infrastructure, that's a huge, huge repository of data to be shared with the private sector and really accelerate this. So again, to be commended. But Mike, I know that's something that you have been looking at for quite a while.
No, it's fantastic. I think there are some other official sector actors who need to follow the World Bank in providing the level of granularity that's required. Certainly, as philanthropy and with NGO partners supporting increasing advocacy around some of these regulatory issues. You just mentioned, Marissa, the credit rating agencies. There's an NGO we support, Nature Finance, just published some work with Vera Songwe, who's a former IFC colleague of Jamie's, really starting to unpack this. And I think for a lot of colleagues in the room, this is an area where advocacy from financial institutions and London really will be the world's leading green EM finance centre, pushing for some of these unnecessary barriers, whether it's data or risk modelling, to be removed. Just a couple other points quickly to complement colleagues. Again, it's worth looking out for work that's going on. The Inter-American Development Bank, a very close partner obviously of the World Banks, which is working with Brazil on this innovative FX hedging facility. There's a great entity, TCX, has been doing this in frontier markets for a while. But I think, again, for a lot of financial institutions in London to try and reach out and get more involved, push other official sector partners to look at those kind of solutions to a macro risk like foreign currency risk. And then just to lastly mention, again, as a counterparty to the Capital Innovation Lab at the World Bank, we've been supporting there's a network called Finance in Common, which is 500 of the big national and regional development banks. And they're another really important partner. They're often in country, Marissa, Rhian-Mari, people like BNDES in Brazil, DBSA in Southern Africa. So again, I think people need to reach out to those kind of institutions. We're funding a Capital Innovation Lab with that network. Again, there's a lot of space for people to come in and get involved in that and help lend the technical know-how that Marissa's mentioned to get capacity in country, tackle this risk premium.
Brilliant. And one of the questions that's come in actually picks up on your points there, Mike, which is, came in anonymously, but what would you like the role of the MDBs to look like in the new collective quantified goal? I think I don't know, who wants to maybe, it's a tricky one, but who wants to maybe touch on that? Jamie.
You guys need to give us...
You need your marching orders.
We'll keep raising our game as much as we can.
Yeah.
Yeah. But we welcome it, all the feedback.
I mean, I think there's a direction of travel that you've set in your evolution roadmap. Other of your MDB partners, the AIIB, has a strong climate action plan, but we obviously, lots of other actors, private sector, but for us with policy advocacy in civil society and philanthropy need to help you move forward on that, because you've given us great examples, but there's clearly a lot more you could do. And additional capital is ultimately, something that we all need to push for, and it goes back to the fact we will need more public money, and that's going to require innovative taxes. We're going to need ultimately to give Jamie and the other MDBs more capital, and that's something that is being skirted around a little bit at the moment because those issues of fiscal space are sensitive, but at some point they have to be addressed, and I think the private sector has to be willing to also call for that not sort of shy away from those discussions.
Thanks, Mike. And Derek, if you'd like to elaborate.
It seems to us that it had started well with the Ajay Banga, the World Bank already, in terms of the review of the mission of the bank, in terms of the mandate, the way that the capital is going to be deployed, the usage of the balance sheet. I think there's a lot of really interesting effort being done. Now the question is how much of that can be replicated with other similar institutions worldwide. You spoke about crowding in the private sector. The question is to avoid to crowd them out. So that's kind of the type of collaboration which would be required, and force institutions to work together that have not always by design worked together. Then there's another question which is always asked to us is, who are the de-riskers? And many people are looking at the DFI MDBs, but somehow it's unfair as well. It's not them. They have a business to run as well. They have, people that they have to report towards. And that's, I think, a big question that we need to crack. And for me, last thing I wanted to share that we have not spoken enough, I think it's the clarity, visibility, stability, predictability of policy framework to support this type of effort. Because amongst different geographies, you can see the differences being for agriculture, for energy, for, there's a lot of framework to be built, which I think we're not there yet. And that's the point about the country platform that you raised before. There were multiple attempts, but I think there's a new generation of such effort that needs to be overtaken.
That's a really important point, actually, Derek. Sorry, Marissa, you can say.
I was just going to add that it wasn't specifically the question on what can the MDBs do, but I also think when we think more broadly about those who are helping to set standards for sustainable finance, also reminding all of us that we can't have the rules and standards be written in Western circles and not really getting deep into the issues that are prohibiting capital from going to the emerging markets. A very good example that you raised the topic of some of the innovative forms of finance like sustainability-linked instruments. A lot of the now industry best practice says things like in order to be a good SLL, you have to have a Scope 3 target. In many of our emerging markets, Scope 3 is still early days for the countries or the companies within those countries. And they're saying, I want access to the SLL market. What if my KPIs, because these are linked instruments that the capital is subject to you delivering on a series of KPIs. Maybe in my country, the S is more important. It's people should be the KPIs, not the E Scope 3, or I don't have the capacity yet to confidently deliver a Scope 3 target. That's okay. We want that behavior change and that movement towards sustainability, and the capital providers are very starved to participate. But these are the sorts of things I think we have to work through in addition to just purely MDBs. It's like there's a lot of systems thinking here that has to focus on these markets.
Yeah, and again, just a baseline for the audience, I'm sure most people are familiar with Scope 3, but obviously there are emissions that are not within the direct operations of the organization, just so we see the complexity and the need for data transparency and all the points that Derek was making in order to be able to report on those.
And that east-west or north-south, whatever we're calling it.
Yeah, exactly.
A combination.
Jamie, you're waving at me.
Just one observation, which is the risk of these kind of conversations is we conflate the art of the possible with the art of the necessary, right? And so in the absence of sufficient political will, there is things that we can improve. How do we get more out of the multilateral development banks? How do we squeeze current budgets just that little bit more? And how do we nudge financial markets with voluntary standards and products? It's all reverse engineering on a problem that needs political will. Markets respond to regulation. If there's a price on carbon, the markets will move, right? So, you guys are voting in a month. There's 50 countries voting. Unless we get the political will to move, the capital will not move at the speed or the scale necessary. So there's an obligation for all of us within the art of the possible to do as much as we can. I always worry a little bit with these acronyms and panels that we distract from the art of the necessary, which is significantly more political will globally and nationally.
Mike.
Yeah, I do just want to emphasize that I think lots of us in the room have been involved in supporting voluntary initiatives to get things moving, whether it's on data, whether it's on carbon markets, whether it's on transition plan frameworks. Unless this is all regulated, it's just not going to provide you as financial institutions or real economy businesses with the foundations to do this work at scale. And I think, again, it's not necessarily always natural for the city to want to advocate for more regulation, but I think really where it comes to the issue of scaling these kind of innovations, it's going to need regulating. And it's a brilliant point about doing it in a way that is designed to be global. And there are some great, I know ISSB partners and others are in the room who are really in the vanguard of making sure that those kind of standards are global, not just written for the G7, but it's going to have to be regulated everywhere. And the city is going to need to lobby for that, which isn't, naturally a comfortable place, but people are going to have to do that.
It's the regulation, it's the accountability, isn't it? That's the point that we needed. The voluntary codes and the targets can get us so far, but at some point we need some accountability, and that's the bit that we need to move towards. Okay, we've got some pretty spicy questions that have come through. Right, let's see. Jet Peas, referred to by the panel, have only had limited success. MDBs like EBRD have expressed frustration. Should it continue to be rolled out into more countries? And thanks to Dr. Rutan Fanawala for that particular question. Who wants to take that one? Jet Peas promise so much, and in theory, a fantastic way of tackling both the social and the environmental and the political and private capital risks. We've had 2 so far, South Africa and Indonesia. I think, are we doing in Vietnam? Yep.
Vietnam.
With plans to go further. Marissa, what's your view from the private sector?
So it's absolutely right that I think, as ever, when I say we're in a moment where ambition meets the hard graft of delivery, and that's sort of what climate broadly defined, right? High ambition setting, and then you get into the work to deliver, and it's complicated and hard. And so it is a little bit, I often feel 3 steps forward, and then 2 steps back, and then hopefully 3 steps forward. And I think that's a very good expression of the Jet Peas. What I can say is that we're working our way through it. At the starting point, we're bringing many actors together who aren't used to working with each other. There was assumptions that were set, the capital's here. Great, where's my bank account? I want to get that 20 billion. Well, the 20 billion actually is predicated on early decommissioning of coal. Okay, let's tackle that. So it's this type of an exercise that we're working our way through, as I say, step by step by step. And that's why the speed isn't happening as quickly as we would like. In the case of Indonesia, we had to change laws. There's so much here when you're trying to do this at a country level. So I think that appreciation is not necessarily always well understood, and the media loves to jump on the negative, right? Right now, and particularly in sustainability circles, I wake up every day to the negative, extreme headlines about how bad everything is. And those of us who are practitioners, who are seeing step by step, we're actually seeing those changes happen. It is very frustrating to all of us. So part of this is rerunning the narrative about those success stories. So that would be my answer to Jet Peas. We're still working.
Jamie?
So I would say they offer a sort of microcosm of what's going on more broadly in the current COP and multilateral process, right? So this year in Baku, what will be negotiated is, there's always an acronym, the NCQG, the New Collective Quantifiable Goal. It's a number, it's hopefully a big number of climate finance. That is fundamental to sustaining political will for what will happen next year in Belém in Brazil, which is rolling out of new, again, there's an acronym, Nationally Developed Contributions, country plans. And if for emerging markets and developing countries, the political will to be ambitious in their country plan is influenced by the support and willingness of developed countries to contribute to that. And they do 2 transition routes. They do here's our transition route, and there's a contingent one, which is what we could do with more support. And that's kind of what Jet Peas were trying to do, which is how can we help you be more ambitious? But there is a fundamental full stop, which is what is politically viable and what is, is there the political will, and is it politically viable within a sovereign? And, if you here in the UK had Deus Ex Machina come down from above and say, we're going to help you be more ambitious, what will it take? This is a complicated place with many stakeholders and many actors, and that's the reality. So the world is trying to help each other be more ambitious, but ultimately, unless there is, clear, strong leadership from the top and the political will to do it, there ain't a tool that's going to work. So it's a balancing act of carrots and sticks, of collectively trying to support ambition. And that's just not easy.
Yeah, so I think we're all agreed that the ambition of the Jet Peas is absolutely in the right place. The execution and delivery, rubber hitting the road, it's hard graft, it's going to be difficult, but we're working through it. And maybe it's people a bit too quick to criticize things that are very, very complicated to do. Maybe that's our takeaway. Derek, if you wanted to add.
No, I just wanted to make a quick comment on the fact that JPs is G7 towards developing economy, right? But what we have been observing, we spent quite some time on the topic of fragmentation. That countries are refocusing on their self-interest, right? Their own priorities, and you cannot really tell them what to do to a certain extent. Sorry. So there's a tension that is without doubt being created because of that. So going forward, it creates a lot of difficulties that needs to be tackled. And what we are being observing is the fact that from south to south, there might be more opportunities. So you have development banks now funded by the BRICS. They seem to talk to one another in a different ways than the old blocks are talking to them. So there's possibly an opportunity there, and we can try to, a certain extent, influence that type of dialogue. But we've seen, for example, sovereign wealth funds as well, going towards a hydrogen project, biofuel project, sovereign wealth fund generated by emerging economies towards developing economies. And it's relatively successful. So maybe these are new angles that must not be underestimated.
I think that's a great point, because if you feel that you're being imposed upon by rules from somewhere else that you didn't, as you say, have any part in creating the problem, and now you're being asked to solve, create the solution, it does create, I would say, tension points. So you can solve it south to south, but there's also an enormous amount of learning that, because the North has been on this journey for a while, made a lot of mistakes, and somehow sharing some of that best practice into the South without being preachy, without imposing, understanding the starting points. That's why I say also making sure that the voice of the South is in the room when these standards are being developed, or when discussions about what is the right policy. If we can also have that cross-border understanding, I think that helps all of us.
Hear, hear. That actually brings me on to a question here that's come in from Sarah Stefanini. It was something you mentioned earlier, Marissa, when you were talking about the innovative decommissioning finance and the fact that they're creating carbon credits. What is the role of carbon markets in raising finance in emerging and developing countries? How do you avoid risks to ensuring a just transition for them? Which is clearly, to my mind, it's about listening, it's about involving, it's about co-design, but I'm interested in your view.
Yes, so there are many ways the carbon markets can play a role in helping to finance all of this. One of them is this idea. This is just an idea, so I don't want to get ahead of itself about this. Could we create carbon credits for decommissioning? You have to have someone who's willing to buy those credits, but there's it's in some respects an easy calculation, unlike some of the other projects which are more complicated, that are nature-based, for instance. But the Voluntary Carbon Markets Integrity Council has set up the core carbon principles. So what are the, what I'd say, principles behind a high-quality credit, and one with integrity, principles like permanence and so on. I do think that's an important component, because in the just transition, the risk, of course, is that perhaps you go and sell a carbon credit as a country, monetizing something like your natural capital assets. And if you sell them at the wrong price, and they aren't managed well, that is a risk. So a well-managed and consistent understanding of what a high integrity is critical, but that can provide a real unlock, because where is a lot of the natural capital in the world resident? It's in the emerging and developing markets. So if we can figure out a way to do something with those assets so that you aren't incented to, sadly, deplete those assets, if there's a payment to conserving them, which ultimately is a beneficial contributor to either mitigation of climate change or, frankly, the resilience and adaptation that we're talking about, those are areas that are really important. So I'm a big believer that, and as our speaker said, Sabine, early on, we've got to put a price on carbon, because that also helps to pay or tax the bad things we're doing to incent the behavior change toward the good too.
Thanks, Marissa. You mentioned the Integrity Council on Voluntary Carbon Markets. Mike, you still on the board? I know you were.
So yeah, I think it's a great point about the work that's been done to strengthen the supply side of those markets, including embedding a lot of safeguards, something the bank is an expert in, also around just transition. I would come back, I think, to the issue that without demand side stability and growth, that is very difficult, that high quality non-debt capital flow. And I think that requires regulation of both corporate transition plans and financial sector transition plans if it's going to give either real economy corporates the confidence to buy credits. I think for things like coal decommissioning, we would take a view that probably instruments, carbon-linked financial instruments that may be part of portfolios rather than credits that offset real economy companies, but those mechanisms require regulatory certainty. And I think that's being overlooked at the moment. I just come back on the issue of the just transition piece also that was in the question and on the country platforms, that there is a longer history of making those kind of collaborations work. 20 years ago, there was a whole framework. The UK was very leading in these PRSPs, these poverty reduction strategy papers that were country-owned plans. Relatively flexible budget support was given. It was linked to things like the HIPC debt relief program in low-income countries. So there is a history of doing this reasonably well, that in the climate space can be leaned on. There's maybe more we could do to learn on that. And then these carbon instruments, I think, sit in that context, but country-owned in the use of them and the design of them.
Perfect. I was just going to highlight, because we've touched on nature a few times in this pilot, in this panel, and there is some work on an international advisory panel on biodiversity credits, which will be the new frontier of actually immobilizing capital towards nature solutions. And what's interesting in that, and full disclosure, I sit on the panel, is that we are working with Indigenous peoples and local communities, not only to get to consult with them, but to have them co-design how this market actually works so that there is actually a just and equitable dispersion of those proceeds. So learning our lessons from the carbon markets and making sure that this money ends up with the actual stewards on the ground. So again, like you say, country-led, and not just country-led, but led by the stewards in those jurisdictions as well. Final question from Simon Thompson this time. Majority of the economic activity in emerging markets is via SMEs, with the main source of credit bank lending. How do we unlock lending to SMEs? I mean, we've spoken a lot about big infrastructure projects on this panel, but SME, one for you maybe, Marissa, you're nodding there.
Yes, we're a very large trade bank and supply chain finance bank, and our observation is, as much as we can create the same demand signal we just talked about, that is one big unlock. So for instance, in the SME community in developing markets, they're typically part of a big, long supply chain where the end buyer happens to be in a developed market. Think of your large cap companies, the Unilevers and Walmarts and whomever of the world. If they can have a very strong demand signal, which has a series of expectations, then the SMEs can respond to that. And obviously, there's always the question of who's going to pay for that, what is it going to cost me? But if they have confidence in that demand side, finance providers like ourselves can say we're biased to financing those monies that are directed toward people who are doing things the right way on climate and other topics like the social, right, the just transition, workers' rights, all of the sort of S and ESG issues. We think that makes these SMEs better credit risks. And the demand side saying, if I demand it, then the system, again, begins to work. So we're actually at work, we've just announced, and it's quite public, something called We Connect. This is very much deliberate financing toward female entrepreneurs and SMEs in developing markets, where we're working with the demand side and those participants, and we will be biased toward lending to those who are following a sort of set of expectations. So that is one example.
Fantastic.
I mentioned really briefly beforehand breakthrough financing models. So we published some with regards to supporting regenerative agriculture. So we deconstructed the food production value chain, if you wish. And it's about the transfer of capital between the consumers and the producers. So I think there's a lot of work to be done, but it connects directly with SME and farmers, which I think is of high level of importance.
It circles right back to adaptation again, because if we promote those sorts of practices, often led by indigenous communities, they are more resilient to the climate effects. We see it, there's actual science to that, and we promote more of that practice by saying on the buy side, if that's what I demand, then you create that behavior change or that focus on those ways of farming.
Well, on that positive note showing innovation and optimism, I think we're going to draw this panel to a close. Thank you. That was a fantastic discussion, and thank you to everyone who submitted questions. Thank you so very much.